Hello. In this video, we're going to take a look at the opening range breakout strategy, the ORB as it's sometimes called. My name is Kory Gill. You can find me on Twitter at Kory Gill. First, let's get a couple points out of the way about the opening range breakout strategy. One, it's not just one single strategy. There are infinite variations on it, and it's not the holy grail of trading strategies. Many people are successful with it, and I believe that success requires taking every signal, every trade, every day. As you may or may not have already found out in your own trading, if you try to cherry pick certain signals, you'll just get all the wrong ones, right? So you must get used to taking small losses frequently and letting your winners run. And this is actually one of the things that the opening range breakout strategy does and will teach you. So what is the opening range breakout strategy? Well, let's just start here. For one, the opening range breakout strategy is nothing more than a line in the sand. When the price goes above the line, you go long. When price goes below the line, you go short. But in reality, most people do something more like this. You take the first 30 seconds or 1 minute of the trading day and choose the high and low of that time. So in this case, that is this first bar. And from this first bar, you would actually use the low of that first bar and the high of that first bar as your range. And then this range is your opening range. So it's from this range where if the price goes below, you're short, and if the price goes above, you're long. And then there's further refinement on this strategy because you need to know where to exit. So there's a concept of taking profits at typically 2 target zones. When you go long and short, you usually want to do 3 units. So here you would be short 3 units. And let's say your first target was down here at, I'm just making things up as we go as an example. If your first target was minus this many points and plus this many points, you would take partial profits at this level. So you would, of the 3, you would take 1 off, leaving you 2 positions. And further down here, you might have a second level. And again, these are plus and minus the same levels usually. So when the price got down to this level, you would take 1 more off. So you've taken 1 off here, you're getting paid. You take another 1 off, you're getting paid again. And now you have that third position we call a runner. And usually with the runner, you let that one just go the whole rest of the day unless you get stopped out, let's say back here at break even. And that's something typically people do is once you sell one at this target 1 level, you would move the stops for the remaining 2 positions to break even. So it gives you a situation where you sell one here, you're getting paid. You sell one here, getting paid again. And price goes back to here, you're getting out for scratch. Look at it from another direction. If you went short at, whoa, how do I go back now? Sorry about that, we're back. So if you were short here, you would have taken 1 off at this level, and the price never reached your target 2 because you got stopped out here for the 2 remaining positions. So this is one way of defining risk, taking profits frequently, and moving stops to break even. Another variation that people do is, let's say they went short here at this level. They would have taken profits here. And then when they take the profits at the T2 level, they might move the stop on their runner to the target 1 level. I've run variations on this, and honestly, you're better off to let that third position, that runner, go as long as possible, because over time, you do not want to miss that day where the market just comes almost all the way back to here, kind of like this bar dipped right into the opening range and does a fake out and just goes, 200 points in some other direction. Yeah, so that's one variation on the opening range. So real quick, another variation people do, especially with stocks, is they might use the first 30 minutes of the day for the opening range, which if we look at the first 30 minutes and grab the high and low of the first 30 minutes, then people would use this range as their opening range for a stock. And maybe instead of just looking at only one day, maybe you carry things through, but the same principles would apply, that your long above and short below and how you scale in or scale out might be differently. Some people use, if I might just draw here since this looks like another short, people might use targets every few points, or use Fibonacci levels, or some other means of finding support and resistance places. So you might you might use a strategy where you initiate a short because it dropped below this range, and sometimes people do it where it has to be one tick below the range, not just at the range. So you want to see trading actually happen there. So you would initiate a short position here, and you wouldn't actually exit your short position. I might not have mentioned that earlier. Well, if you're long above, that it implies that if the price had actually gone to the other end of the range, you would close out whatever positions you have and then initiate a new long position when the price went above that level. And you could see here, depending on how many units you put on, you could and here you just don't worry about the price. It's not on the other side of the range. And then here you might take profits at target 1. You take profits at target 2, target 3, target 4, and you have that runner or some number of positions left, and you don't get faked out. Although I don't have this drawn perfectly. This might be a point where it came all the way back to the range, and this might be computers knowing that people trade this way, and this is where they trap you. And of course, then the trade could go this way, or maybe it reverses and the price goes back through the range. One thing I can say is no one ever went broke taking profits. So if you ended up flat here and you're done trading at 10 o'clock in the morning, I'm on Pacific time. Maybe you've already made enough for the day. So this is a rough intro into the opening range breakout strategy. I have a few more screens to show you here, so let's continue. So what I thought I would do here was give a glimpse into the calculation. So if you've seen my other videos, or if you haven't, go to YouTube and you can find an in-depth analysis on the opening range breakout strategy, where I use Tableau to look at the different parameters in some of these. And again, I didn't touch on every single permutation possible on that, but it will give you an idea of how the strategy is formed. So we look here. So I run my strategy, wrote it in PowerShell, and we can see that over the last 30 days that we could have made $2,000 with a 53% win ratio, and this shows in the summary that we would have made 40 points over the last 30 days, going from a 6:30 a.m. Pacific start to a 1:15 p.m. End, and that's using 3 points for target 1 and 11 points for target 2. And we stop out at the end of the day if things are going wrong and we're chopping 4 stop outs, and we are using a runner. This resulted in 133 trades where we exited trades. I'm not actually counting. I realize I'm not actually counting the number of contracts traded. So depending on your commission structure, we just take this as a 100 trades and you're $7. Buying 3 contracts or whatever, that's $700 to make 2,000. So that may or may not be something that's palatable for you. What I get out of this is, as you can see here, I track this when we buy, when we sell, when we stop, and all this. And I'm going to go through this again, so don't just stick with me here. And we can see on a daily basis what each day looked like, and we can see, losing 300, making 500, making 800, and this is using the ES futures, which is $50 a point. Made 800, and at the end of the month, we did make the $2,000, 40 points. But this is what the layout of the month looked like. So, here's a day where we stopped out. Looks like a $1,500 loss. Next day, you lose another $1,200. You make back the $1,200, lose $1,500, and then you have a series of wins of. You can see here, I have a series of wins of a couple hundred and some thousands. Probably getting back in positive territory again. Lose 1,000, make 3. This is a wash between these 2 days, minus 1,800, plus 1,800. In the end, it adds up, and this kind of goes back to the point that you have to do this every day. You have to take every trade. You have to stick with it, and that's to be successful of using the strategy is just following the strategy, trusting the strategy, and letting statistics and the law of probabilities work in your favor. So let's get this out of the way and let's focus on a specific day. So I took the details that my script provides. I made it so it can print out exactly what it does at every time. So we're going to look at just January 17th, 6:30 open on the opening range. And these are all the trades it did and how it stopped out at the end of the day. So let's just take a look at the 17th. Let's focus here on this screen where we're on the 17th here. And you can see the first bar. I'll even zoom in a little more. I think I can get this going. So we zoom in a little more here. So here's the high and the low of the very first minute of trading. Again, some people use 5 minutes. They use 30 seconds. However you want to set your range. And so this high, you can see with the white line here, that's the high of our opening range and the low of the opening range. And I put a blue line, cyan line here, 1 tick above and 1 tick below the opening range. And you see this yellow line defines where the bar opens. Some people do this to have more of a bullish area and a bearish area. And I have profit lines, target 1 below, target 1 above, target 2 below, target 2 above. So now if we zoom out again, we can kind of take a look at this day. Let's see, we went till 8:57. Let's zoom out a little bit more to make this look good here. Here we go. This will capture enough. So we're going to follow along on this text. And what you might want to do is pause the video at some point and read through this and follow along. But I'll do the best I can to kind of guide us through this. So the day starts. We wait for the opening range to set. And then we have to be ready to trade. This bar opened here and immediately broke through the opening range, or the ORL, which is the opening range low, or ORH would be the opening range high. So right here we'd be initiating that short position we talked about, and that's at 6:31. And as we can see here at 6:31, if I can highlight this, we did short 3, so it's 3 units. And you can see the stop was set on the other side of the opening range at the 326.25. These values are in this teal here. Some people like to use the exact opening range, high or low, a tick above, tick below. You could do 2 ticks on either direction to not get faked out, like see here. The computers know people trade this strategy, so I think some of this is they know you're trading right at the opening range, 1 tick. Maybe this is 2 ticks. It's kind of uncanny how this looks when you put it in this kind of format. Again, you just have to trust the probabilities, take every trade every signal, Let's keep going here. So we're in a short position, and you can see price goes down. We get close, it comes back up and touches this, but our stop isn't until the other side of the opening range. And right here at 640, this should have exited. So yep, here we go. Look at this. Right here, we are closing 1 unit. We had 3, remember, so now we're down to 2 left. So we're getting paid. And because we did this, we moved stops to break even. So now our stops are going to be at this 2350 line, which is this teal line again. I set my stops to in this strategy at 1 tick outside of the range. Some people do it 1 tick inside the range for stops as the break-even point. That way, if it just comes up and touches this range. But again, if you're doing that, you can see right here, price went in. This looks like 1 or 2 ticks inside the range. So, if you're doing that, this would have been one of the places where you would have got stopped out from this trade if you're trading this. And long term, which one provides better results? We just have to keep running the numbers and figuring this out. But again, it's a law of averages and probabilities. So getting back to the day, moving stops to break even. And you can see here at 649, right here, we would have stopped out. So the strategy now says waits for prices to get back in the range. And at 658, it would have said, okay, we're back in the opening range. Let's reset the whole strategy, long above, short below. And that's what this indicates. And then you can see at 658 we went short again, which should be this bar, right? This one here. 658 we would have went into the range and shorted and went back out. Yeah, it's by 1 tick. So you can see we're short again. And price muddles around inside the range, and we finally break out below, but we do not get to target 1. Instead, it comes to the other side of the range, and right around here, we would expect that we are now taking our losses. And each day is different, of course, how wide this opening range is. Today, the opening range is 2.25 points, which is $112.50 for the price. So here we're cutting our losses, which is good. You take small losses, let the winners run. So you can see here that we stopped out at that 7:29 time, and 7:29 right here. This bar would have been the one that stopped us out because it went above this other level, and we would have then reversed and went long. And we set the stop at the other side of the opening range. And then it did come down here at 742 and come outside of this range right here. So this is where we would have then reversed and went short. So now we're taking, that's 2 losses, I believe, right? 2 times we've lost $112 getting stopped out, but now we're short again. And we did get paid at 814 right here, and move stops to break even for the remaining 2 positions. And right around here, what is this, 845? 845, we would have then stopped out of those 2 positions. And because we've stopped out 4 times, the strategy just says we're probably getting chopped, so we're just done for the day. So we stop trading. You could, how many stops you use or how much churn you get. That's, if you find the answer to that one, you can get very rich if you can do this. If we step out and look a little bit at the opening range, you can see it like this. This day, there was some chop and we get stopped out. This day, a little bit of chop in the beginning. So you were long, you went short, you were long, you're short. But if you held out, eventually we did get to a target 1 and we rose to target 2, and we would have sold that runner position right here at the end of the day, that 3rd position. Some people carry it overnight as long as there's a longer trend. They do it to build positions because essentially you have a risk-free position. So if you don't think the market's going to do something wild, you can hold that runner position and set your stop down here, break even on that position, and it's a free trade in that sense. So if tomorrow, the next day opens up and you have that 1 runner, you can have that 1 runner and now you add on the 3 positions again and see how the day ends. And you could do position building that way. So that's another way people use the strategy. So again, there's no one opening range breakout strategy. There's tons of variations. Something I thought was interesting here, another good example, it did happen. Actually, the strategy, if we look at this day, this is the fantastic day where if you just had this big view, it's like, oh yeah, I was long and short and hit target one, we'll go up here, hit target two, and I sold my runner up here. This is what a fantastic day looks like, where the runner is higher than target two. However, the reality of the strategy as I have written it for 4 stop outs, we would have got target one here. We would have went long, reversed and went long here. Would have got stopped out. Would have reversed, went long here. So I think on this particular day, because of some of this churn here, the strategy actually stopped trading right around this point. So the strategy did not participate in this part of the run. So again, it's what you do, how you employ it, and again, the opening range. There's nothing that says you have to do 6:30 in the morning. You could have easily just said, you know what, I'm just gonna, and the day might be going on. You might say this looks like a consolidation, and you will see price consolidate sometimes at these previous levels. The market does have a memory. These target twos could be a resistance point on the way down. You see here the previous day's target right here could contain other price actions, and how this works. You see here this target one level did contain prices here, so you might use that as information of this being a bottom or a low risk place to enter another type of position or another type of trade, as the market does come down and touch these other previous opening range levels. Yeah, so hopefully this gives you an insight a little bit into opening range strategies and that. And let's take a look here, like, where can I get some more information? I don't have an exhaustive list for you. I don't get paid by any of these people. It's just a place where I've contributed some of my knowledge, but use thinkscript.com. If you search there, you will find 14 pages worth of discussions on the opening range breakout, some strategies and studies and discussion on how to do this for Thinkorswim. And you'll see it's the same type of discussion where maybe they've set some opening range for 30 minutes, and then there's a long above, short below type range. You can find that. Second, I know that Pax, he's been an opening range breakout trader for a long time. He has this website and some members, and I know he's been successful doing this. And again, it's not the holy grail of trading strategies, but he's been doing it for over 20 years. Again, I don't get any compensation from these guys. These are just 2 resources that I know about regarding the opening range. Well, I'd like to thank you for watching this video on the opening range breakout strategy. Again, my name is Kory Gill. I can be found on Twitter at Kory Gill. My DMs are open. Feel free to send me a question if you have one, and I'll try to get to as many as I can. Thanks a lot, and we'll see you next time.